Well, good morning, good afternoon, good evening, everyone, wherever you are in the world. Welcome to the IPMI Platinum Group Metals Refining Seminar. You probably be used to seeing Larry Drummond here. Sadly, he can't be here today because of family reasons. So instead, you have me as MC. I'm John Butler from Mitsubishi Corporation, and I'm also a director of the IPMI. We have a great session lined up for you this morning. We have presentations from TD Securities, Sabin Metals, and BASF, and we'll also be conducting a Q&A session at the end, at which we welcome your comments in the comments box on the right-hand side of your screen. Please post your questions there. It falls to me to do the necessary housekeeping, which includes our IPMI antitrust statement, which I'm obliged to share with you. You should also be able to see this on YouTube. So bear with me a second while I get the technology to work. Hopefully I'll be able to share that with you in a moment. Sorry, taking a little while to load up here. So in the meantime, let me just give another couple of housekeeping notes. This event is part of a series of events this week, which normally would be held as real events. But of course, with the current COVID situation, we're doing them virtually. There is another session tomorrow, which Sandra will no doubt have already shared with you. We also have coming up in June a series of real events for those that can be there and virtual events for those that can't. This is our June 2021 seminar. It's going to be held at the Grand Hyatt in Orlando and also virtually. There'll be a sampling and analytical session on June the 8th, an Autocatalyst seminar, which is on June the 9th, and our security and anti-money laundering session on June the 10th. Registration details will be coming by email, so please look out for that. There's also some further details on the IPMI website. I'm having a little trouble sharing this this statement here on antitrust. Sandra, I don't know if you have to make something live to make this happen.
I am not seeing the presentation to put it up for view.
Is it too long to read, John?
I think that's probably the way to do it, Brad. Let me, unfortunately, you'll have to put up with my dulcet tones for a little longer. We'll try and put this up as soon as we can, but let me just say the IPMI's antitrust policy is as follows. Federal antitrust laws apply not only to private businesses, but also to non-profit trade associations such as the IPMI. The IPMI has in place antitrust policies and procedures that apply to all IPMI meetings, webinars, presentations, and discussions. During our virtual annual conference and also in our presentation and discussions, certain topics are off limits. These include, without limitation, any discussion on pricing, price changes, price differentials, profit margins, discounts, production, supply, production capacity, inventories, sales, marketing, matters relating to suppliers or customers, or any comparable pricing information, generally or in connection with any particular customer. IPMI's General Counsel and staff will be monitoring the presentations and discussions to make sure that no one inadvertently raises any of these prohibited topics. Both staff and counsel are available to answer any questions. The IPMI's full antitrust policy statement can be found on the website www.ipmi.org. So with that being said, I will now introduce our speakers for this afternoon. We have a great lineup. We've got Bart Melnick from TD Securities, who will be giving us a market overview in a presentation covering reflation, the emissions control policies, and also precious metals supply. We'll then delve into detail in one of the biggest challenges in the refining sector right now, that is high carbon feeds. And we have Brad Cook from Sabin Metals to give us a detailed presentation on that topic. And then finally, we have Craig Ostroff from BASF, who's going to talk us through petroleum versus petrochemical catalysts refining. Again, a very relevant and timely topic right now. We'll save the Q&A session for the end so that we can do it as a panel discussion. And as mentioned, if a question pops into your head through the presentations, please put it in the comments box. The team here will be monitoring this, and we will look out for that in order to put it on the panel, put it to the panel and address it. So without further ado, still having a slight technical difficulty here uploading Bart's presentation. Bart's going to go first. We're then going to have Brad and then Craig in the running order. Let me try and upload Bart's presentation here.
For all those watching, we practiced this about a half an hour ago, so
And it worked.
To upload.
Everything worked.
Everything worked a half an hour ago. So
It'll be all right on the night.
There we go.
Yeah, hopefully you can see this now.
We see it.
Yeah. Okay, well, let me introduce Bart. Bart Melnick, of course, a great friend of the IPMI and known to many of you for his work over a number of years. He is Global Head of Commodity Strategy at TD Securities. He has some 20 years experience analyzing global precious metals, base metals, energy, and financial markets, as well as the North American and global economies. He has worked closely with commodity, equity, and FX trading desks in Toronto, New York, Chicago, London, and Singapore, and has several forecasting distinctions and top global rankings to his credit. Bart contributes to the TD Securities strategic view by providing commentary on commodity and various other financial markets and how those relate to the sectoral and macroeconomic outlook. Bart is also a sought-after media source for many leading print publications and business television programs, including Bloomberg, Reuters, CNBC, BNN, The Globe and Mail, The Wall Street Journal, and Barron's. His forecasts are also part of the global consensus. Prior to joining TD, Bart was a global commodity strategist and senior economist at another major Canadian bank. He's also served as senior economist and senior analyst in treasury and risk management at a major Canadian chartered bank. Bart holds a master's degree in economics from the University of Toronto with a specialization certificate in international finance and banking. Bart, we very much forward to this presentation. The floor is yours.
Well, thank you very much for the kind presentation, and all those who are logged on and watching, thank you for joining. I hope I will be interesting. I try to be, and you know, now that apparently, according to our marketing biography, I walk on water, it shouldn't be too hard to disappoint you. You're probably expecting a lot more than I'm able to give you, but I'll do my best. So the title of this presentation is Reflation, Tightening Emission Standards, and Precarious Supply, a Mana for PGMs. So ultimately, I think we'll give the secret away right away, are quite optimistic on the PGM complex, on platinum, on palladium, mainly because I think we're going to see a significant cyclical increase in demand, and the supply side will continue to be tight. And despite what we're seeing in gold today, with gold, you know, on the precipice of breaking 1,700 to the downside, we continue to think that the precious metals environment is conducive to investor interest. And as I'll go through my presentation, I'll demonstrate why, particularly for platinum, investor interest is so crucial to keeping the price firm. And I think I'll try to touch some structural changes in the global economy, in the U.S. economy, that is trending towards a CO2 free future. Now, Jonathan, if you can move the slide to next one. So I think it's instructive to first go through what has happened in the COVID era and slightly the post-COVID era, with the vaccines being fully administered around at least the Western world. So as you can see from the chart here on the left-hand side, we had a massive decline in manufacturing activity around the world as COVID reared its ugly head. And, all of a sudden we were faced with shutdowns, shelter-in-place orders, aggregate demand simply collapsed, all economic activity dropped massively, and we've had some economies drop 20, 30, 40% on a monthly basis. And with that, demand for industrial metals, demand for precious industrial metals. It was a period where we've witnessed a massive drop in everything from oil. If you recall, not that long ago, oil was in negative price territory. We saw a massive decline in copper, and of course, platinum and palladium suffered as well, with platinum really getting a hit. And the expectation there was that we were not going to see a quick recovery, and that this market would be in a massive surplus because of the slower demand. And I think many analysts have forgotten that COVID not only hit the demand side, but it also hit the supply side. And then, recently we've seen a significant recovery in all the pricing, and I'll go through that in a bit. Could we move to the next slide? So the question is, given COVID, given the massive dislocation and shutdowns and reduction in economic activity that caused, how is it that precious metals on the industrial side, like platinum, like palladium, even silver to a great extent, are, with platinum nearly more than double, well, not today, but roughly double where it was from the lows? How is it that we are in such better shape and the outlook is so much better? Well, we can point to vaccines, but certainly that is not the start of the story. What we've seen immediately after COVID is the so-called potential growth, as you see on the left-hand side of the slide, simply plummet. And you see that line, that light green line, just dropping massively. Price expectations dropped with it. So we had a significant fear that with a much slower economic outlook and basically, people stuck in their homes, we would have a deflationary spiral. For a time, back in March of last year, almost a year ago now, we had a liquidity crisis in the treasury market, in the equity market, and yes, in commodities. Even safe havens like gold got hit because the world was afraid that liquidity will dry up, and basically we will have a liquidity crisis soon to be followed by a solvency crisis and essentially a collapse of the global economy. And of course, accordingly, all prices dropped. Now enter the Fed. The Fed very quickly realized this cycle that it had to do something. And I believe as well as March 27th, where they came out with a policy of unlimited QE. They very quickly came to the conclusion that they need to stabilize liquidity, and they ejected literally trillions with balance sheets massively being bloated. Not only did they buy treasury to stabilize the government paper market, but they also ventured into buying MBS, like last time, mortgage-backed securities, and for the first time, corporate bonds. So if a company was insolvent or close to it, the government would buy their junk. Well, I don't want to call it junk, but junk bonds at one point reached yields at below 4% for the first time ever. So central banks around the world, and that's the Federal Reserve, that's the ECB, the Bank of Canada, Bank of England, and others have added massive liquidity to the structure and stabilized everything. No big secret, that helped to stabilize demand expectations. And if we can move to the next slide, please. And this is well put here. So monetary stimulus just exploded here, and balance sheets moved massively higher, and that meant that there wasn't a liquidity crisis anymore. And then all of a sudden, I think people started worrying about potential inflation, and were thinking that with the Federal Reserve stabilizing the structure, and at the same time, we saw massive amounts of government stimulus. I think in the US, some $4 trillion. There's another $1.9 trillion coming. There was just recently $600 or so billion being introduced into the economy to provide income supports. And with that, aggregate demand did not collapse. And as if you can see on the chart on the right-hand side, there is a very, very close relationship between the balance sheet of major central banks and the precious metals complex. What we did here is we simply took a weighted average index of silver, platinum, palladium, and gold. And they did all very, very, very well following the crash we've seen in March. I think silver and platinum were the big stars. Platinum has many reasons why it's doing better. Could we move to the next slide, please? And one is, as gold at the time was doing well, investors also piled into platinum here. And you can see the positioning here, and also you see what has happened to the ETF holdings. So investors, by virtue of buying the metal, I'm going to later on explore why they could buy the metal and why they may continue to buy into 2021, into 2022. But ultimately, in my opinion, it was very much a reflation bet, very much a bet that the global economy will recover and that real interest rates will continue to be extremely accommodative and along the yield curve in negative territory. That likely is changing now, but platinum, I think, initially reacted to that, and of course, the stimulus. Could we move to the next slide? Well, the combination of record interest rates, liquidity, government spending, and now as we move into an aggressive vaccination program in the United States, the UK, and I think soon to be in much of the Western world, as the news of vaccines came out, we are now also looking at demand moving higher. But to move back, why I think these markets have responded so well, platinum and palladium, is the fact that we've lost massive amounts of supply. In South Africa, in particular, that was an issue where on the mining side, on platinum, we lost some 15% of production. This is something around 800,000 ounces or so on the mining side. On palladium, we've lost, give or take, 10%. So very, very, very large. Of course, platinum got hit more because it's more of a South African sourced metal than other ones. Even on the secondary side, on the recycled metal, we've lost, we estimate, maybe 12 to 14% of supply and 10% roughly on palladium, 14% on platinum. So now the combination of improved demand expectations and improved expectations of a tight market, in essence, we think that platinum is going to be in a deficit. And the reason behind that is that we saw some 450,000 ounces of investment demand in 2020. We think this is going to be almost as strong, maybe even stronger in 2021. And when you take the recovering demand expectations for fabrication, which we judge to be about 15, 16%, with Autocads moving up 25% for platinum, and Autocad's moving some 11% in 2021, after dropping 16% for platinum autocatalyst demand and some 12% for palladium. You know, this could be a little higher, a little lower, depending on which data set you look at. But in the end, when we look at the constrained supply side, and even when we look at 2021, 2022, we're not going to really see a massive increase in supply. We'll, I think, be very lucky if we are back to the 2019 levels. You know, we'll see what happens with the Norilsk disruption, which will take out maybe some 60,000 ounces of palladium out of the market and some 120,000 ounces, 160,000 platinum ounces out of the market, and maybe 120,000 palladium ounces out of the market. How bad this gets, but it certainly demonstrates that mining is hard, and quite often companies will overpromise and underdeliver. Not because, you know, they're sketchy in any way, not because they want to mislead anybody, but sometimes things happen, like in the Arctic, where water gets into your shafts and you have to close for a bit. You know, certainly that's the case with Norilsk now. You know, we're hearing news that that will be fixed soon, but we don't know what will happen. But that is something that moves the market. I'm not trying to project, you know, how long this is staying, but I'm just saying, you know, given what has happened, that how the market is realizing it. So we are looking at palladium demand recovering quite nicely, platinum demand, and pretty much across all spaces. Electronics will be big, particularly now that we are moving more and more into EVs, electrification, very much like silver. Electronic components are much more prevalent in these sophisticated cars that are using batteries than they are in your standard vehicles. And I think that is a trend that will grow. And as the economy stabilizes, as everybody gets vaccinated, I think there's quite a bit of pent-up demand. And hence we are saying that we're going to see a big increase in vehicle demand globally. We think after a 10% decline, about a 15% decline in 2020, we're going to see maybe a 9-10% increase with both Asia and Europe moving higher. You know, platinum benefits from the fact that Europe had a lousy couple of years, and recovery should do well for demand. And let's not forget, there are tighter standards now for catalysts. You have countries in the world, China, India, implementing pollution control policies where they really haven't before on heavy trucks, and there'll be more loadings in Europe. And this is why I think you have a big disparity between the rate of change on the car sale increases versus auto catalyst demand. I think, you know, the better, the stronger improvement on the auto catalyst is because of regulation. So we have regulatory impact and secular impact. Could we move to the next slide? And here is the AutoCAD chart that shows both platinum and palladium. But I will disagree with a lot of pundits out there who are talking about these structural changes for platinum and palladium because we're going to be using hydrogen fuel cells, which will be loaded with platinum. I think that is a story, but I don't think it's a story for the next year or two. No matter how much money the Biden administration puts into the system, these are longer-term trends. But that doesn't mean that investors aren't watching and potentially adding to the tightness by taking position in these metals. Next slide, please. Jewelry, we think, should start improving as well. Jewelry tends to work along with economic activity. No big surprise that 2020 saw lousy jewelry sales. I think most people don't tend to buy jewelry when they lose their jobs and their income drops, but with improvement in economic activity, with massive amounts of savings, certainly in the United States, places in Canada where we had very, very robust income support policies, there will be, I think, extra money. Here I'm just, demonstrating on next page, please, page 9, demonstrating what has happened on the supply side. Platinum was the big one, as I mentioned. But when you look at this chart, that is pretty stark. And yes, there'll be a rebound in 2021, but will still won't be to levels on 2019. And when we look beyond 21, 22, there is limited amount of investment. I am not quite sure where all this metal comes from longer term. If we assume that there will be, higher loadings down the road, where more cars will be produced, and I think the shift towards electric cars and will not be, a full-fledged shift into pure EVs. It'll most likely be into hybrids, which still have very significant loadings. Probably a little better even with new technology and new requirements than older diesel and gasoline cars. So demand should be good for the next few years as the recovery gets driven by low interest rates and by fiscal stabilization spending, and also by pent-up demand. So I think these markets tighten up, and I think we continue to have investors play their role. And certainly in the case of platinum, they are very much responsible in generating a deficit, which certainly would not be the case if it was just industrial and primary and secondary sources of production. Next slide. So here you see the relationship between balances, deficits or surpluses versus price. So there tends to be a positive impact over time, which makes a lot of sense, that scarcities in these markets will drive prices higher. And that's exactly what we have seen, with a bit of investor fervor, particularly for platinum, that has been responsible for that, in my opinion. Next slide. We are looking, at proof here with the lease rates, where when supply dried up, we've seen, South Africa, and then at the same time we had better demand prospects, where the front end of the curve was very, very bid and tight, and of course those lease rates moved higher. To the audience here, I would say that this is a distinct possibility. If we should see another significant tightening on the front end, where we can certainly envision a situation where we could again have more stimulus, demand moves higher, investors actually taking metal and taking it off the market because they think it's going to tighten up, we could see lease rates spike again. For both platinum and palladium, we both like the metal. Ultimately, we think that palladium hits previous highs quite easily, probably even higher. And, a three-hander on palladium would not be at all surprising to us under a rosy demand scenario, and given the constraints on the supply side. If we could move it to the other page, please. And we are seeing that manifest. I think we're on page 12. At this point, where what we are seeing is investors recently taking pretty strong long interest in platinum, not so much in palladium. I think the expectation in palladium is that it'll be a bit of a laggard relative to platinum, but there's certainly positioning. One, I think, just incrementally, the beta in platinum could be higher because the depth of the decline was higher, with Europe possibly improving. That should impact, platinum-based catalysts more. And at the same time, I think investors are also looking at the possibility over the next few years in the US, probably in the next 2 or maybe a little bit more, the possibility where you're going to see more substitution of platinum for the cheap, palladium for the cheaper platinum. Platinum has been outperforming as a ratio of palladium, and I think over time, if you have the technology that circumvents, the problems of heat and reduction of catalytic properties really work and being applied, I see no reason why the substitution shouldn't take place as we move on, making platinum outperform it. But look, we still like palladium very much. We still see, potential three-handle over the next 2 years or so. With platinum, we would not be at all surprised to see $1,300 or so over the next 3 quarters or so. Next slide. I just have some of the models here that formalize a lot of the projections that I've been talking about, that you can review at your leisure. And that one is for platinum. The other one is for palladium. Next slide on page 14, please. And I think that is all where I'd like to end, and hopefully we have a robust Q&A session discussing some of this. Thank you very much. And this is the team.
Well, thank you very much indeed for that presentation, Bart. That was a great overview of some of the challenges and the issues that are facing the PGMs right now. While you were speaking, Bart, I finally managed to get the antitrust policy up on the screen, which I can just share with you now while the handover takes place. I know that there'll be a lot of questions. I certainly have some myself, and I would just ask you to keep those coming in the live chat, and we will address them one by one in the Q&A session at the end. But in the meantime, I'd like to hand over to our next presenter, who is Brad Cook from Sabin Metals, and he'll be speaking on the issue of carbon in refining. Brad joined Sabin Metal Corporation in late 2012 and was named Vice President of Sales and Marketing in January 2015. He has spent over 35 years in precious metals businesses and has been a member of the IPMI since 1999. Brad served on the executive committee starting in 2007 and was president for the Institute for the 2012 to 2013 term, and is currently an active member of the board of directors. Brad, we're very much looking forward to your presentation this morning, so I'll hand the floor over to you.
Thanks, John. Thanks very much. Let's see if I can get through the technical challenge here first. or maybe not.
Now I have experience of this. If you'd like me to do it, Brad, I'd be very happy to. And you just tell me when you need the next slide.
If you've got it up, that's great. I'm not sure why it's not there. I've got it open in the application, and it, as Don said, this worked a half an hour ago.
It'll be all right on the night. Yeah, hopefully you can see that now.
Great, thank you. And I'll just call them out for you. Well, thank you for that introduction. I appreciate it, John. I've got a very appropriate title, I think, here in the carbon negatives, but and people know me, I'm not a negative person. I detest negativity. And although the title may be appropriate, I understand the fact that a successful relationship depends on achieving a approximate 5-to-1 ratio of positive interaction versus negative interaction, as anyone who is married, or I suppose anybody who used to be married, will understand that that is the truth. So if you click to the next slide for me, you're going to look carefully here and try to absorb as many positive, good thoughts as you can from this slide quickly, so I can try to stay in a net positive relationship with you, at least until my presentation is over. And if everybody's got a half a dozen or so of those, you can move on to the next slide and we'll get started. So there is a trend in the petroleum and petrochemical refining industry over the last 5 years or so that sees an ever increasing percentage of carbon in the catalysts that are being sent for reclaim. Some of this material coming in, ladies and gentlemen, is over 40 and even 50% carbon. And these facts have been corroborated by many other precious metal companies around the world. So this isn't strictly a Sabin problem by any means. It is unclear whether this trend is a result of less and less in situ burning, pre-reclaim burning, in an attempt to sort of save money on the turnaround, or if perhaps it's a result of longer run times for those catalysts in the reactors, or possibly it's related to more difficult feedstocks coming in. But the most likely answer is that this is a combination of all of those factors. The decision to delay maintenance and turnarounds during COVID has certainly been quite common, but the high carbon issue predates COVID by several years. Now, I'm not an expert in feedstock choices, and I'm not a process engineer who can analyze run times and things like that. So I'm not going to attempt to explain the more technically motivated decisions, let's say. But I would like to talk about the bottom line that we all must address, and that is the removal of the carbon. So not that long ago, pre-reclaim in situ burning was standard operating procedure for just about every precious metal catalyst change out. But now it seems it's become far more common to dump the used catalyst and just send it out to the precious metal reclaimers in that dirty, coked up state. Now, I obviously don't have detailed data from our competitors, but the increase in carbon loaded lots that are shipped to Sabin, if you could click the next slide for me, John, these are lots that must be kilned as a percentage of the total coming in. So you can see, even prior to 2011, those numbers were hovering right around 10%, up and down the 10% point. But the rise from about 2016 to now is triple. So we got 3 times the amount of carbon loaded, coked up stuff coming in. Next slide, please. I would like to thank Don Suenos of Gemini for this data that he put together. Those of you that were at Don's presentation about a year ago at this time in Houston, he looked at 2 case studies from separate units using different types of catalysts, but both used the same basic timeline for that in situ regen burn. And what they found using pretty standard protocols for setup time and the time to restart afterward, etc. I've rounded that off to a 24-hour round number for discussion purposes. And each unit did contain 200,000 pounds of catalyst. But as I said, they were different types of catalyst, different products being made. So you had different revenue per day reactors running. The first one was a $550,000 a day reactor running it at optimum operation. And so there, you're doing the math, their in situ burn cost was about $2.75 a pound if they did it themselves, of course, and then the other nearly double the revenue per reactor was obviously nearly double the cost per pound to change that out. So an average $3.74 a pound for the for the petroleum refiner, let's say, to do that in situ pre-reclaim burn themselves. Now, I don't want to get us into any antitrust thin ice here and start talking about how much all the various precious metal reclaimers charge for kilning, but I don't think I'm in any danger when I say it's a lot less than that. We certainly can tell that from the front end view, our catalyst owners out there in the refining business, they see that front end as a cost savings. If they have to remove the carbon and they're looking at an average of $3.74 a pound, it gives them a faster return to production if they can drop it out dirty and ship it out to the precious metals refiners like Sabin and have them remove the carbon and other contaminants. So the high levels of coke and carbon and other contaminants that are coming in are presenting higher operating costs to the precious metals refiner. And on the front end, at least, it looks like to the catalyst user that they're saving some money. So the next slide. What do we need kilning for in the first place here? Well, basic sampling theory stresses homogeneity, obviously, so there's no getting around the kilning issue. The contamination levels within the catalyst, whether it's carbon or moisture, etc., have to be eliminated or at least greatly reduced to make it possible to take an accurate sample. And it goes without saying that if you've got a bad sample, there isn't any lab in the world that's going to be able to get the correct assay. So this is bad for everybody. Inaccurate sampling and the erroneous precious metal content calculations, there isn't any way for me to estimate what would happen because it's a bad sample. Let's face it, it could have more carbon than it should. It could have less carbon than it should. But when you've got that over a certain agreed percentage of contamination, you're literally rolling the dice. And lastly, just to mention, whether it's a hydrometallurgical precious metal recovery method or a pyrometallurgical, low carbon feed into that process allows for the best precious metal recoveries and overall efficiencies there. So reclaimers are doing what they can to handle this growing need for the excessive kilning. We, for example, just built our third kiln and got that certified last fall in North Dakota. So, technically that would eliminate 1/3 of the kiln backlog. The problem is the dirty stuff just keeps coming. And now the repercussions are being felt by the catalyst owners. And I dare say a little bit of rippling into the precious metal marketplace. So what I want to do from here is just look at those larger effects, what I'm calling the carbon negatives, and what might be seen in the market and in our business, but also, that financial pain. You can click the next slide for me, John, sorry. So the first downside is the increased wait times that catalyst owners are facing to get their precious metals. Catalysts that come in clean, that is with carbon, benzene, moisture, etc., all inside of acceptable tolerances at the various Sabins of the world and those like us, they go straight to sampling. And the typical settlement time for relatively clean materials, and what I mean by that is the day of receipt at the precious metal refinery all the way to the day that the precious metals are finally delivered back to the client or the value thereof is roughly 3 months. You could say 3 to 4 if you're dealing with an international relationship. But this is going to include all the processing, the laboratory analysis, the exchange of the results, the final paperwork, everything. So the clean catalyst might have come from a product that simply does not generate carbon and benzene, a production line that doesn't have any of the problems associated with it. It might have had a pre-reclaimed burn from that customer, or they might have sent it out to someone, a specialized vendor that did the pre-reclaimed burning for them before it shows up at the doorstep of the precious metal refiner. Now, the settlement time, the turnaround time for the precious metals when kilning is required is at least twice as long. You're looking at sometimes heavily coke catalysts, those ones I'm saying are 40 and 50% carbon. They have to go through even the best kilns 2 or even 3 times to finally get that full carbon reduction to a reasonable few percentage points that makes sampling accuracy acceptable for all parties. So that time frame I'm talking about doubling is including, waiting in line behind all these other people who have coked up catalysts that showed up at the doorstep of the precious metals refinery before you, and the kilning time itself for your dirty stuff to go through the kilning process. Obviously related to that is, are you leasing? Lease rates on platinum, as Bart has been discussing, lease rates on palladium. I'm only half joking when I say that recently we hit a point where there really was no lease rate on palladium because nobody had any. Now that's a crazy situation that we don't want to see too many of these things that pop up in our lifetime, of course, but it has been the case. And even a mathematical simpleton like myself can deduce that if you have enough platinum for 100,000 pounds of typical catalyst, 6 months of leasing is another $1 per pound added to your imagined costs of that change out, of that turnaround. So it's not unusual for the catalyst owners to spend $500 or even $1,000 a day on lease fees, and therefore those perceived savings up front by dropping it dirty and sending it out for carbon reduction, they evaporate very quickly on the back end when their procurement department or what have you is dealing with the lease rate on their platinum. And then lastly, and it would take a much smarter person than me, Bart, to determine exactly what the effect is here, but trapped precious metals are a fact. I mean, the warehouse is full of material waiting behind that kiln pinch point around the world. They're sitting, those are ounces trapped of PGM that have been removed from circulation, essentially. And if there are months of backlogs at dozens of places, it adds up to a lot of ounces in this holding pattern. As Jonathan pointed out last year, I believe, the silicon carbide issue in automotive catalysts has created a similar issue. So we're sort of in double trouble in the PGM market with this regard. The silicon carbide issue and those improved emission standards that Bart referenced have caused the similar issue to arise in the automotive market. And the specialized processing is now necessary. There are only a few places in the world that can mitigate those contaminants, quote unquote, and an untold number of platinum group metal ounces are trapped in the inventories waiting for their turn in line to be processed. China has effectively closed the export of PGM catalysts now, not without its subtleties. But it is a rather protectionist move from China. Over 80% of PTA production, for example, pure terbolic acid is in China, and that carbon catalyst is fairly high grade palladium, but that's staying in China now. It can't be exported. So it goes beyond the problems that Mr. Trump and Mr. Xi had getting along, and it's now like regulatory hazardous declaration level stuff. So that is another restriction on the flow of platinum group metals around the world. And as I say, somebody smarter than me, like Bart, can present on the details of the mining industry as he's done, the supposed the supply nosedive and you know the South African troubles and etc. But you know, ore quality has been deteriorating for years. It's just more expensive to pull each ounce out of the ground to begin with, and as we see, demand isn't going down. So the next slide is what are we going to do about this? I can only see a limited number of possible corrective actions here. The first one is that all the petroleum and petrochemical catalyst users have got to stop coking everything up. Well, that I'm just kidding. that's not going to happen. I can't see that being the case. They got to do what they got to do to run their business properly. The next suggestion would be that the PGM reclaimers have to add more kiln capacity, and as I said, we have at Sabin, but that's not going to achieve a full correction to this problem, and it almost certainly will mean higher pricing is coming from your precious metal refiners if their costs are going up and their storage problems and everything else. The next one is sort of a middle ground suggestion, the option for catalyst owners to calculate the full cost of skipping that in situ burn and start making it the norm again. I think that would work, but as I said, I'm not a pessimist and I'm not a psychologist, but saving money makes people look good at their jobs. And on the front end, if you're in charge of the change out, you can show the savings in your area of responsibility, and the future repercussions of what's being done are kind of cloudy. I don't really see the big change happening voluntarily. I hope I'm wrong about that. But then the last thing is that the PGM reclaimers are going to bump up their kiln charges because of their higher costs and their additional capacities and whatever else, until it gets near the level of that $3.74 per pound for the in situ burn. And then the catalyst users would reevaluate just dropping and shipping it dirty. I think this will have the desired effect over time, but I don't think I have a lot of customers listening right now who are going to say, oh, we completely understand now why somebody's rates might go up on kilning charges. I think most people are going to get mad. They're going to fight against any price increases and not really understand the issue behind it. But competition is great. They look at the price level and they decide they're going to go elsewhere. And that's fine. It's always encouraged as long as it's on a level playing field and it's just one guy's opinion after 35 years in this business. But the cheapest option in the precious metals business is almost never the right one. And quite often it turns out in the end to not have been the cheapest one to begin with. But that's a whole nother topic I will save for another presentation. And that's what I got. Thank you.
Another superb presentation. Thank you, Brad. That really gave a great overview of some of those challenges from carbon in the petrochem industry, but also, of course, more widely, as you refer to, in silicon carbide, and coming on top of some of the issues that we've already heard about. I think we've got a little bit behind our schedule, but it's all interesting discussions. So not to worry. Hopefully, we'll still have plenty of time for the Q&A at the end. So it just falls to me to say, last but not least, we have Craig Ostroff, who is the Global Sales Director for BASF's PGM refining and chemicals business. Craig has more than 30 years experience between BASF and the former Engelhard Corporation, with numerous commercial and operational roles in and out of the precious metals space, including in refining, chemical catalysis, adsorbents, nitric acid gauze for the nitrogen industry, and temperature sensing, both using PGMs and optical pyrometry. Craig has a BS in engineering, in chemical engineering, in fact, and he currently resides in New Jersey. I will now hand over the floor to Craig, and we look forward to your presentation. Thank you very much.
Can you see it, Jonathan?
Yep, that's it. It's up there now. Thank you.
All right, cool. Thanks, everybody. Thank you for taking the time out to listen. This is a presentation. It's a little bit lighter than the others, but Brad really gave me a great segue to talk a little bit about the language and the details around some of these chemical catalysts and what makes them more or less complicated, what makes it more or less difficult to find a reclaiming home for them, and so on. You know, a lot of the people that are on the presentation now or on the seminar are Autocad collectors and processors, and let's just say it's a lot more straightforward. Either you're in Autocad or you're not. You know, maybe we may not be able to do SIC or sensors, but we all generally run Autocad essentially the same way. But in chemical catalyst, and more specifically things like palladium on alumina, there's a broad spectrum of materials and how to handle it and what to look out for. I'm going to try and just enlighten a little bit around that. So this is the mandatory disclaimer. This basically says do not mortgage your house on anything I say today. I think Brad said it well. There's a lot of us doing these things, and you know, we all do things different ways and look at it differently, but this is just a for your information kind of presentation. So you have chemical catalyst and you need to find a home for it. And you, especially if we have a lot of Autocad guys that once in a while they happen upon a load of chemical catalyst and they think I can just send it to my Autocad refiner and it's the same kind of thing, but it's just not. But anyway, you've got the chemical catalyst. You're not sure which refiner can handle it. You may not be aware that we all can or can't. And it gets frustrating. You're going to reach out to us. You're going to get offers that don't look alike. You're going to get a lot of questions back, and it can get quite frustrating, I'm sure. So with that, there's a couple of misconceptions that maybe help. So the process to recover precious metal is the same across all refiners. No, it is not. Everybody does it a little bit differently. Maybe there's a different order. I mean, the basics are relatively the same. We don't all have a kiln that Brad talked about. And even if we do, and it's the most important part of this presentation, we may not be allowed to use the kiln for what others may be able to use it for. And that really is the gist of this. Another thing different about chemical catalyst is about time to assay and time to settlement and what happens. So generally speaking, when you have chemical catalyst, you want the metal back because you're going to get a new catalyst, right? And while I may be able to get you an assay in 30 days, as Brad said, I cannot get you the metal in 30 days, nowhere close, right? And it's just different. You know, and even if we settle it early, the metal's not there. And in a market where there's not a lot of liquidity and you can't lease it, it's a real challenge. Another and most important misconception sometimes is that physically or chemically similar catalysts, if I can run it at, say, if I can run one catalyst that looks like this at BSF, I can run another one that looks kind of sort of just like it at the same place. And a good example would be palladium on alumina. The one on the left probably can run at BSF. One on the right, I probably can't. They're completely different catalysts. Now, why are they completely different catalysts? One is a hydrogenation catalyst, and one is hydrotreating. And let me just sort of lean into this, to a true story here. So I've been in this role for about 15 months. I only handle third-party business. I don't manage BSF's internal business. Now, BSF has, 500 odd sites around the world. We use and produce a lot of catalysts, but mostly use a lot of different catalysts, some that we make, some that we don't make. But just like anything else, we have to refine the metal off of them. And I got a call from a colleague that said, I keep getting this catalyst rejected by Seneca. And I said, what's the catalyst? And he said, it's PGC5, which is a pyrolysis gasoline catalyst. I call the people at the refinery that are in charge of EH&S, and I say, why are you rejecting catalyst? And he said, well, it's a K-waste. And I said, it's not a K-waste. They said, how do you know? I said, because a K-waste comes from an oil refinery. And they said, how do you know? I said, I know. It fits in the definition. And they said, well, it says gasoline in the title of the catalyst. And I said, I understand that. But pyrolysis gasoline catalyst is a byproduct of a steam cracker. And they said, what does that mean? I said, it means it's from a petrochemical plant and not from a refinery. How do you know? I said, well, first of all, BASF has 500 sites, as you know, and not one of them is an oil refinery. But we do have 5 steam crackers, and that is a petrochemical plant. And so it took a little bit of convincing, but we finally were able to process the catalyst. True story. So we all kind of do these things, right? All of the reclaimers do these things. We may do them in slightly different orders. Maybe we have a smelter, maybe we don't. But essentially, you're going to grind it, you're going to sample it, and eventually you're going to refine it. I'm getting a lot of background noise from somebody, by the way. But the key to all of this is, if I'm not permitted to run it, I can't. Doesn't matter if I have the equipment to do it, right? I can have a kiln just like Brad's, but I can tell you I don't have the air permit that allows me to run certain catalysts versus others, and that is really important. And you can help us, the refiner, know what you have by answering a couple of the simple questions. So you have the catalyst. We're going to ask you some things. Is it wet or is it dry? Okay, and just like Brad talked about, did you decoke it or did you in situ burn it? Much better, more sophisticated phrasing. Thank you. But did you decoke it? Did you burn the living daylights out of it to get it as clean as you can? So one, frankly, you can take a retained sample and even have it sampled yourself. And even if you did decoke it, what is on it besides carbon, besides degraded carbon, which is essentially coke? What else is on it? Now, generally speaking, we will send you a profile form. I think almost all refiners will do this, and the profile form will again ask basic questions like this. But most importantly, in the very beginning, it's going to ask you, where does the catalyst come from? And when we say where, we don't necessarily mean country. We care about the country. It can't be a sanctioned country, but that's really not what we're asking you. What we're asking you is, what process was it used in? Hang on a second. Of course, right now I get a smart card. Okay. Why? Because the where, just as in the anecdote I report, it has to do with how to run it, right? So, and basically we're talking about, is it from an oil refinery or a gas plant, same category, or is it coming from a steam cracker, which is a petrochemical plant? This is just a very small snapshot of a very small beginning of a very large profile form that we would send you and other people might send you. And the most important question is the first box. You can really figure out if we can handle it or not just by properly filling out the first box, right? Where are you using it? What did it do? And that will help us know where on the value chain it is. So this is an oil refinery. How do I know it's an oil refinery? Well, I Googled oil refineries and I grabbed the picture. But I also know it's an oil refinery because I can see in the background behind that stack there's an FCC unit. So an oil refinery and a gas plant, which really does almost the same thing for let's say shale gas. Okay, neither the crude or the gas is any good to anybody until it's cleaned, until it's separated into its constituents and safe to transport. So the refineries and the gas plants just get these extracted materials into a usable form. We feed crude oil or we feed untreated natural gas, and what do we get out? In an oil refinery, you're going to get fuels. You're going to get jet fuel, diesel. You're also going to get some associated gases, just like you will in a gas plant. You'll get ethane, you get propane, and in the case of an oil refinery, you'll get naphtha. Very important. Naphtha kind of looks like it might be a fuel, but it is not. It is a very specific collection of molecular weights of hydrocarbons that feed the steam cracker. But if it's a catalyst that's used inside this fence, You can call it a refinery catalyst, a refining catalyst, a petroleum catalyst, but it's not a petrochemical catalyst. And that just helps us when you decide you want to refine it. At least for someone like BASF who doesn't have the permit for it, we know that we can or we can't take it. This is a steam cracker. All right. If we say steam cracker, we mean petrochemical. It's just the language of the industry. As you're driving by on the freeway, you may not notice that it's an oil refinery, but you will notice that it's a steam cracker if you know what to look for. It's this massive square set of furnaces. This is a mega cracker. It's actually in Abu Dhabi. Produces 1,500 kilotons of ethylene per year. On the cold side, you see those stacks. The cold side is where the catalysts are. That is where, I know for us, that's our bread and butter. We're going to be permitted to run catalysts from that part of the plant. What does a cracker do? Cracker takes the ethane and the propane or the naphtha in liquid form, and we make ethylene, propylene, and butenes. It is the building block of the chemical or really petrochemical industry. Almost everything that eventually makes its way downstream to your toys, your medical plastics, your tires, what have you, your carpet, it all starts back here. It all starts back here. There's about 450, maybe 475 of these in the world. You may find more of them now in the United States than you ever did because of the shale gas revolution. The money is not in the energy of the shale gas. The money is in the associated gases, the ethane and the propane. And that's why they build these crackers, so you can make polyolefins from it. A little up close look at what goes inside these furnaces. These are very, very hot coils where the cracking takes place. And basically you're just cracking, you're creating a double bond in the ethane or the propane to make ethylene or propylene. And yes, you are then making also pyrolysis gasoline, which my colleague was objecting to. And the pyrolysis gasoline is then fed back. It's actually treated with a hydrogenation catalyst, and then it's fed to the aromatics plant in most cases. So really what we're talking about here is the value chain. Where does your catalyst sit on the value chain? Again, to help us, help you, help us determine if we can run it, how to run it, and how to treat it. So there's a very clear line of delineation between the petroleum refining segment and the petrochemical. And this is one value chain. I chose diapers. It's just an easy one. Diapers are, if you work your way backward, diapers are made with super absorbent polymer, really big product by BASF and other companies. It's a miracle material. It's really cool. And it's made with acrylic acid. And the acrylic acid is made from propylene. And the propylene comes from the cracker. So if you have a catalyst along anywhere on this value chain, we're going to call it a petrochemical catalyst. It's much easier to be permitted for. It's less likely to be covered in sulfur or other bad actors, and we probably can process it without having to kiln it the way you heard in the prior presentation. If it's before the cracker, you're talking about propane, naphtha, ethane, and a lot of things that go into reforming molecules to get it to the cracker, and that's where really the border is, and that's where you call petroleum refining. And so, just in summation, if you're still wondering what you have, if you're on the refining side, it could be a reforming catalyst, it could be a fill in the blank catalyst, hydrotreating, hydrodesulfurization. All of these are going to have actors on it that, if you're not permitted for, you can't refine it, even if you have the assets. But on the other side of this, some very common catalysts that we can refine if we're not permitted for F or K, we can still take your shoe catalyst, which is selective hydrogenation. You can find all of these at the cracker: C2, C3, pi gas, PTA. Brad talked about purified terephthalate acid, absolutely downstream of the cracker, no problem. LAB, linear alkyl benzene, vinyl acetate. And there's many, many more. And all of those are what we would call petrochemical or downstream from petrochemical catalysts. It's not a listed waste. And you'll have a broader range of choices when you go to reclaim it. If it's on the left-hand side, there really only are a few refiners, reclaimers that can take it. And so with that, I turn it back to Jonathan. Thank you so much for your time, guys.
Well, thank you, Craig. Another great presentation there, and replete with a lot of detail that's very relevant to our audience. We've had a great set of questions coming in over the last hour or so, and so we'll open those up now, and I'll act as MC for some of these questions that have come in. So one of the key ones that's been asked in a couple of different ways essentially is about substitution, particularly with these record high rhodium prices and high prices in palladium, which hasn't been helped, of course, by very high sponge premiums. So I'll start first of all with Bart, just to ask you to expand on some of what you said earlier on the Autocat side. What do you think is the potential for substitution, both to replace rhodium in autocatalysts and also potentially to move away from palladium towards platinum autocatalysts?
Well, I think all will be very much dependent on the technology and the efficiency of the resulting product. First of all, they have to make sure that all the regulatory standards are satisfied. But I think ultimately, markets tend to move where profitability is the greatest, or certainly most manufacturers will want to reduce total costs, and I think not only costs, but also eliminate or at least mitigate the risk of supply disruption. So in my view, it is a very wise decision not only to get a bit of a cost advantage by substituting the cheaper platinum for the other catalytic metals, but also to provide the supply diversity and a bit of a geographical supply diversity as well. So if something happens to, under a Russian facility or something in Canada that's heavy on platinum, there are other parts of, there are other sources. But look, from what I understand, there is technology out there that has solved the major problem of reduced efficiency, catalytic efficiencies for platinum in high temperature environments. That's mainly associated with gasoline engines. We really, long term, I haven't the data, but I suspect, in part maybe 15% substitution, depending on what catalyst is possible. Certainly not all. These are complex systems. I'm not an engineer that can tell you the specifics, but from what we hear and what we're modeling longer term, 15 to 20% substitution over the long run seems like it's a possibility.
Yeah. Thanks, Bart. I mean, I think it's especially relevant today as we hit very close to $30,000 per troy ounce on rhodium, and with palladium having taken a bit of a breather lately in the outright price, but still remaining extremely tight in terms of the sponge availability, as Brad and Craig alluded to, with some of the issues that are going on in the refineries, but also still maintaining that very unusual situation where lease rates could potentially spike higher, as you mentioned. To segue into a slightly different area of the autocatalyst side, of course, we're hearing more and more about OEMs and governments around the world who are opting for EV strategies. We heard from Volvo earlier this week, accelerating their plan to introduce a pure EV fleet. I put it to the panel, given that these vehicles typically don't use any PGMs in the autocatalyst, what is your view on this transition, and are we all getting a little carried away with the transition that's going on? Is there still a lot of life left in the old internal combustion engine? Maybe if
before the really smart people start talking, let me just throw out a couple of comments. I think I forget who it's attributed to, but there are no facts about the future. Okay, we're all in a world where certain events can change the timeline that has been predicted and agreed upon by all the large industry groups around the world. certain things happen, and that curveball takes over the impetus to get things done. Whether we'll see the kind of thing that, we had no gasoline in the 1970s, and what happened with the energy crisis and everything was that no one saw the computer chip coming, and having a computer chip in your hot water heater, and electronic fuel injection, and all the things we couldn't see coming. So I think Bart makes a very good point that the technologies that are coming around the corner in 5 or 10 years could really be game changers in more ways than any of us can anticipate right now. I think what we do have to keep in mind is there's the prices and availability of the metals today. Then there's the manufacturers of the auto catalysts, especially because as we all know, that's where 85% of the palladium is, and a lion's share of the rhodium. But the cars that are made today are not going to get recycled for 10 years. On average, it may be 8 now. I don't know if that number has changed, but in my recollection, it was about 10 years. So the cars that are being recycled right now are from the technologies of 10 years ago. So we're in a lag on the auto catalyst recycling, even if the development and discovery of those new technologies and the shift to EV happens more quickly than everybody thought. You still got to stretch before the supply and demand figures start to get really hit on the recycling side, if that makes sense at all. But please, Bart, I'd really like to hear what you have to say.
Well, I'm going to try to have a go on this. I think, for the most part, there is maybe a little bit too much optimism of how quickly the transition into pure EVs is going to happen. I suspect that much of the intermediate goals will be reached, or certainly will be mandated to reach via hybrids, and certainly for the next decade, that certainly is going to be likely the new technology that is being implemented, and I think more widely produced as actually starting very soon, and those very much use platinum, palladium, and the loadings are very similar to what they are in conventional diesels and conventional gasoline vehicles. So I think for the next 5-10 years, there isn't very much to worry about. There is the shift into these hybrids. I think that is going to be much more prevalent than EVs. But EVs have a problem. If you're looking at purely EVs structured around a battery, electric drivetrains with batteries, we're not quite sure where we're going to get the nickel from. We're not even sure where we're going to get the copper from over the next 10, 15 years. When you look at statistics for capital investment in mining, it's simply nowhere near where it needs to be to achieve, some of the targets a lot of environmental activists and politicians are talking about. So that is one big constraint. When we talk to boards of directors, when I talk to executives of mining companies and investors for that matter, there's really no appetite at this point to go very heavy into CapEx. Yes, prices are elevated, and people are talking about the super cycle, and they're talking about scarcities. But really, that is down the road. When we also talk about EVs, we have to consider electric grid capacity. We have to consider generation capacity. It's probably not a good idea to use some sort of sulfur-rich, poor caloric, lignite to power your power station, so then you can feed your electric vehicle, because that's probably, with all the waste, probably a positive CO2 footprint. It's great if you have a 5, maybe even 10% penetration of EVs in your fleet. You can use the spare capacity that happens just because of the day from peak to peak load, from peak load to no load, where overnight you can charge it. But if you're talking 30-40% penetration rates, you're going to have to materially grow not only the grid, but also the generating capacity. And that probably means some sort of nuclear. If you really are going to have a very big impact on CO2 in the transportation sector. And given the regulatory structures, certainly in North America, and I imagine in Europe as well, I'm not familiar with Europe, but it takes a very, very long time. So I think first generating capacity, grid capacity, and mining, it can, from the time you think it's a good idea to the first pour of metal, it could easily take a decade. And I think those are going to be real constraints. For the very long term, there is a lot of development and talk about green hydrogen, blue hydrogen. Green is, what you want to do through the electrolysis process. But that probably means that over the long run, some sort of fuel cell, which is PGM heavy, mainly platinum, but who knows? Maybe the technology can be incorporated to other PGMs as well. So I think over the next decade and a half, the death of PGM demand, I think, is greatly exaggerated for the transportation sector. I think it's going to get a lot stronger as we try to green the planet before it gets weaker. Probably the easy wins are hybrids versus a full whole-scale move into EVs because of the constraints I mentioned. I think this could take trillions of dollars and decades, and then we could move in hydrogen as a different direction. Certainly, I think Anglo is on record, their CEO, talking that there are many estimates now that by 2050, 20% of all energy will be hydrogen. And that is a good thing for PGM sector. So I wouldn't write it off quite yet.
Well, Bart,
I think sorry.
Bart,
Yep.
to add to what you said, this morning on CNBC, they talked about the minor metals, particularly lithium and cobalt, and how they're actually in deficit now. And we haven't even started to ramp up EV production. So as you said, you'd have to be able to mine that. And most of the cobalt, as you know, comes from embargoed countries. We have the embargo on the gold from the Congo, but how do we get the cobalt out of the... So there's some real challenges on 100% electrification of vehicles.
Yeah, and a lot of these metals, certainly, they're byproducts, and it's tough. And there's really no appetite. And we also have the massive volatility in the commodity markets, which I've spoken on this many times, which in fact impact the value of these investments. There's really no effective way of hedging long term, or certainly lack of understanding and willingness. So in essence, your enterprise value can be at 100 units, and then the next day it could be at 20. Well, it's very difficult to attract sustained investment if you have those type of volatilities. Perhaps government guarantees or market hedging of some sort is the solution. But there are a lot of issues and a lot of concerns that the market has about risk and sustained high prices. Why do I say that? And that's by revealed preference. If people really believed that these metals are going to go sky high, we would expect a lot more fixed asset investment in the capacity growth. And we're not. So something is not working, and I think that will impede the speed of the transition, I would suspect. And of course, there's the new technology. There's that uncertainty. Will you need the cobalt, lithium, nickel combination, or battery? I think technology cycle is, you can count it in decades. Maybe next decade there'll be something fundamentally different we haven't thought of, which may not use any. We'll use something else. I don't know. I hear the future. It's very tough to forecast, particularly the future.
Very, very true, Bart. Of course, we're hearing a lot. You've mentioned a couple of times this idea of greening up, and of course, hydrogen having a great role for the future in terms of PGM demand, whether that be in automotive or whether it's in industrial applications where hydrogen can be used as the primary feedstock, and that hydrogen itself coming from potentially electrolysis, which is another technology that utilizes PGMs in the production process. But to think about this a little closer to home in our own businesses, this idea of greening up. One question, and maybe Craig, you could give a view on this. Can the refining of chemical catalysts generate the precious metals chemical that is then needed for fresh catalyst manufacture, which would save time and energy and cost in the process?
Yeah, in most cases you can, but there are just a myriad of nuances of various platinum, palladium, or rhodium chemicals, for example. So you may get rhodium chloride or you may get CPA, chlorobutanic acid, out of your process, but you may need a much more, a different platinum chemical, for example, for the catalyst that you want to make. So you still have to convert that. But yes, your building block for what you start with should be able to come out of your refinery and save you some time.
Yeah. Great. And a question for Brad here as well, regarding carbon contamination in some of those feeds, as you mentioned. Does the high carbon contamination within alumina-based catalysts affect the assays?
Well, that's a good question. I mean, it's a difficult thing to say because we're not in the business of, at least at Sabin, we're not in the business of trying to analyze a sample of alumina catalyst that has high carbon in it, because of sampling theory, we're reducing that carbon down under 5% before it goes through the sampling system and ends up at the laboratory. But I do know that there was an IPMI sampling and analytical council experiment that was done. And Don, do you want to take that? I think you're familiar with the details on that. I don't have Algis here to back me up. You're muted.
You're muted.
Yeah.
Yeah, Al just looked at it, and I think some of the questions came on how you analyze, and Al just said most of the labs, if there's an issue with too much, if they do in fact sample material that has high carbon, and they go through standard ICP, there may be some stuff when they dissolve it in the filter paper. So you wouldn't analyze the full amount. However, what Al just said, and everyone agreed at the time, was then they take the material in the filter paper separately and do a fire assay on it, and they add the two together. So they do get it. It's just if somebody analyzed it quickly and didn't do that second step, they would miss something.
Yeah, and you kind of illustrate the point too, that I'd be much more concerned that someone was trying to derive an accurate sample while the carbon content of the alumina catalyst load was too high.
Right.
Then I would be concerned about Algis and the other analytical geniuses in our industry getting the right number once that sample's in the lab.
We do exactly what you do, Brad. We first calcine it. We break up those chunks like you had in your hand. I guess that was your hand. We do get Coke balls like that, and you can't sample that. You don't know what's in that.
No.
So we have to break it up. And in some cases, we use ball mill grinders. Then in some of those things, we have to put in pan furnaces. We have to get rid of the carbon.
Yeah, the very clear message from a lot of these presentations today is, we have some significant issues to address on the supply side. Secondary supply, as you mentioned, the coking issue, that's not getting any better. In fact, there's signs this may be even getting worse as the frequency of coked up lots comes through. Just wondered if you have any view on that, Brad or Craig. Is this an issue that's going to get worse before it gets better? And similarly on the Autocad side, when do we see this bottleneck of silicon carbide and titanate and other difficult to refine materials coming through? Where's the breakthrough?
Well, on the Autocad side, I mean, you know, the deleterious materials like silicon carbide, it's going, I don't think it's going anywhere. I've heard nothing that it's going to be replaced. It's used for the same reason that it's almost impossible to recover. It's used because it's incredibly stable at high temperatures, right? And so you can't smelt it. It doesn't melt. And that's why it's used throughout the semiconductor industry as well. It's a very expensive material. It's an incredible material, but you can't refine it. And so you really have to use I've heard of there's processes out there that specialize in SiC. I don't understand how it works. I believe it's got to be some sort of chemical, but I don't know the details, but it's not going anywhere.
Right. Yeah.
No, and I completely concur. I think someone told me that if you try to melt that, you actually make palladium carbide, which I don't think anybody
Can't refine that either.
Yeah, nobody wants to be at that either. I think the best use for that is maybe a doorstop. But you have, as I said in my presentation, there's only a couple of options. I think the refiners and you know, this isn't like some kind of warning shot across the bow from Saban about prices are going up or something. I'm just saying that in the marketplace, with storage issues and lead times and kiln capacities being what they are, even if everyone added another kiln, this problem is not going to go away. It's simply going to be, you know, a 3-month wait instead of a 4.5-month wait or something. It doesn't ease the issue. And there are some of us in the industry who can advance metal, but with lease rates and too many people needing that advance of metal, it becomes an upside down proposition very quickly. So I don't see a solution other than the obvious customers with precious metal catalysts and precious metals refiners coming together and meeting in the middle somewhere, somewhat of a price increase, and also some people going back to that in situ burn.
Yeah. Clearly, it's contributing to the tightness that we're seeing in palladium and rhodium, and to an extent platinum. But let's not forget about the primary supply side. And as Bart alluded to, South Africa has had its own issues through COVID, and of course some operational issues at some of the large producers there, which isn't completely clear whether they're out of the woods yet. There's still some ramp up to be done, some processing of inventories built up over the course of last year. But then on top of that, as we heard just in the last week or so, the biggest producer by far of palladium, Norilsk Nickel, has had this flooding issue at a couple of its mines, and it's not clear, as Bart says, what the full impact of that will be. But clearly, it's going to constrained supplies, and some great estimates there on what that will mean. But taking these things together, where do we go next? Where do we go over the next 8 to 10 months in these metals? Are we going to see further record highs on palladium, rhodium? What's the outlook given this heavily constrained supply, these difficulties on the secondary materials, and of course this demand recovery, this bounce back from COVID? But
You're muted.
Sorry about that. I have forecasts that are moving higher for platinum. We're moving from a forecast of 1160 for Q1. I've counted a bad month to all the way to about 1350 by the end of the year. For palladium, I have about 2400 average for Q1 of this year, and about 2,800. So still fairly, but it's going to be very volatile. I think aside from the supply-demand fundamentals of the physical material, I think there is a lot that is happening in this market that I think perhaps this audience may not be as focused. The interest rate environment has been changing, where we've seen a significant steepening of the yield curve, and now the market is quite concerned we're going to have real interest rates that will likely move higher. That is somewhat contrary to the Federal Reserve's recent statements, and other central banks as well, which will want to keep rates as negative as possible in order to facilitate a full recovery. Why am I talking about this? It's not so much that demand will get overly hit with these relatively modest interest rate, but it removes the incentives to get into these metals, so-called monetary metals like gold and silver, which a lot of traders have correlations attached to platinum and to a lesser extent palladium. So we could very well see, as the recovery turns out to be better than expected, interest rates move higher, that yield curve steepening, people swapping out for treasuries because the GOFO might be flatter. And that could have an adverse effect on the investment side, particularly for platinum, which saw a lot of investors in there. And I think we could see, at least temporarily, people taking spec positions away from their longs and maybe moving the price lower. Certainly we've seen that today with gold at one point challenging 1,700, platinum move higher. Moved lower. Why? We didn't really see, in fact, the economic data, the demand data looks better. There was news out that Norilsk may be fixing its water issue, yet the market got hit. So I think aside from the demand and then the physical supply, we have to be very, very mindful of what investors are doing, because certainly for platinum, 200, 300,000 ounce move in or out of ETFs, for example, could very well mean we go from a tight market or a deficit market into a surplus market, which would impact it. Longer term, I think, ultimately these volatilities will be out with stronger demand, and ultimately, I think we will have the prices, I think, but it's going to be messy. It's not going to be a one-way move higher. We're going to have troughs. It's going to be very messy, and I think lease rates will very much reflect that as well, of how that contango or backwardation, whatever it might form into, is going to work. And I think that's going to have a real impact for financing the metal.
Great sentiments there to leave us with, Bart. I'm sure there's a lot more questions. There's certainly a lot of questions in the chat there. We'll try and get back to some of those offline after this event. We're coming up to 100 minutes of this IPMI presentation, so I'm aware of time and the fact that you've all got work to do as well. I just wanted to say a big thank you to all of our panelists and our presenters today. I thank you also to Becky, the president of the IPMI, and of course Larry, the executive director, as well as Sandra and the team for putting this together. As I mentioned, this is certainly not the last of these webinars, and in fact we hope to see you in person very soon in June in Florida, as travel is permitting. So we have the three events on June 8th, 9th and 10th, which will be both live and virtual, as I mentioned earlier. Further details to follow on that. Thanks everyone for a great session this morning, this afternoon. I think we're in really quite unusual times at the moment, given the tightness in the market, the very strong investment demand that's underpinning some of this, but fundamentally the recovery and demand that is taking place in industry at the same time as there are these challenges on both the primary and the secondary supply side. So we look forward to updating you in due course. In the meantime, stay safe. Thank you very much once again for tuning in, and we'll see you soon. Thank you.
Thank you.